Hello friends, welcome to Learn Easy. We will discuss market corrections or crash. Whenever we think a correction is going on in stock market, it may be right or wrong. The market never lets us know in advance if there will be a bear market or if the market is at the top of the correction, and hence it is very essential to understand the market corrections. So without delaying, let us start understanding about the market correction. What is market correction? A correction refers to decline of stock market greater than 10% but less than 20%. A correction can last any length of time, from days to months or more. Market corrections surely hurt short-term investors, but they present potential buying opportunities for those with longer investing horizons. The term correction comes from the historical tendency of these price drops to correct the market by returning prices to their long-term trend. Let us draw a common correction pattern of stock market. In the figure, before correction, when there is a sense that the market is overheated, meaning stock valuations have got too high, big institutional investors make that determination and pull money out of the market. The resulting small drop can send retail investors into a selling panic, resulting in a drop in market. A correction occurs with a market drop of less than 20%. After correction, market corrections usually turn into buying opportunities for investors. As these are both brief and mild, and there is every possibility that market will bounce back. If the market witnesses a decline of more than 20%, it turns into a market crash or a bear market. Let us see some examples of past market corrections. First, market correction of March 2011. This correction occurred after an earthquake and tsunami in Japan. Second, market correction in February 2018. Inflation, interest rates, and the bond market sent shares down in early 2018, though the correction lasted less than 2 weeks. Third, market correction of January 2022. Most major indexes, including the S&P 500, declined more than 10% in the largest drop since the March 2020 onset of the COVID pandemic. Now, what is a bear market? A bear market is an extended period of price downturns when market prices fall by more than 20%. Generally, there is a widespread negative market sentiment accompanied by widespread fear and uncertainty. A bear market resembles a correction, only that it lasts for a prolonged period. Most market corrections do not lead to bear markets. As for example, in 1975, only 6 of the 27 market corrections have turned into bear markets. It is difficult to predict the duration of a market downturn. There is also no surefire way to predict whether a market correction is the start of a bear market. Now, what is market crash? A stock market crash is a rapid and sudden event, often occurring within hours or days, marked by sharp declines of stock prices, often triggered by panic selling, economic shocks, or speculative bubbles bursting. It causes investors to rapidly pull out of the market. A market crash can have long-lasting effects on investor confidence who lose significant value in a very short time. The psychological impact is usually immediate. Let us see the pattern of stock market crash. In the figure, market has declined significantly within a short period. If you find the topic interesting and helpful, do subscribe my channel and press the notification bell. What to do when stock market crash? It is not always possible to make accurate stock market crash predictions. Therefore, it is a better idea to stay prepared for a possible crash than attempt to predict it. Here are a few ways through which we can protect our portfolio and follow the aforesaid rules. First, we have to restrict the urge of selling in a panic. Historically, markets have always recovered from a crash, and instead of selling in panic, we should just stay calm and allow our systematic investment plans, SIPs, to continue. If we can manage to continue investing irrespective of market conditions, we will reap the reward when the market recovers later. Second, we have to restrict the urge of buying in panic. Like panic selling during a market crash, it is also important that we do not make a panic buying during a market crash. Panic buying can be described as a state of mind that pushes us to make investments indiscriminately, which can become an obstacle to reaching our current investment goals. Instead of panic buying, we should plan our investments before market actually tank. But to do this, we need to know how high or low our risk tolerance is. Only then we will be able to accurately decide how much of our existing portfolio can be moved from such as debt mutual fund and fixed deposits to higher risk assets such as equity mutual funds. Preventive measures like circuit breakers and trading curves are implemented to curb panic selling and stabilize markets. Third, we have to keep our portfolio rebalanced. Portfolio rebalancing is a strategy that helps in reducing the overall risk in our investment portfolio to provide better risk-adjusted returns in our investment. This strategy involves buying and selling investments periodically so that the weight of each asset class is maintained as per our targeted allocation. It might not be a good idea to rebalance our portfolio in the middle of a stock market crash. We should instead consider letting markets settle down a bit before rebalancing our investment portfolio. Fourth, we must take advantage of tax laws. The profits generated by selling mutual funds or stocks are called capital gains, and these are subject to capital gains taxation rules. A fall in stock markets can be an ideal opportunity to increase the post-tax returns in our investment by using a technique called tax loss harvesting. Tax loss harvesting involves selling our mutual funds or stocks at a loss so that we can accumulate a capital loss. This capital loss can then be offset against capital gains from other investments to reduce our tax burden and increase the post-tax returns from our investment. The tax loss harvesting technique is commonly used by investors towards the end of the financial year, that is in February and March. A market crash offers the perfect opportunity to book a capital loss by offloading some of the poorly performing mutual funds or stocks in our portfolio and replacing them with potentially better performing investments. Fifth, we must protect our personal finances. A stock market crash impacts a lot more than just the value of our investment portfolio. Stock market turmoil can have a different impact on different individuals. Impact of stock market turmoil can be minimized by creating a personal cash flow statement. A cash flow statement is a record of all the money that is coming in and going out daily. By maintaining a personal cash flow statement, we can organize our finances better so that a stock market crash does not impact our ability to take essential expenses such as utility bills, rent, tuition fees, etc. B. By creating an emergency fund. A way to protect ourselves financially in case of emergency is to create an emergency fund amount up to 2 to 3 months expenses. C. By managing our debt. As a rule of thumb, a stock market crash is not the best time for taking on additional debt. If we do so, we will run the risk of becoming caught in a critical economic situation. Sixth, we have to invest in equities but choose carefully. While equities are cheaper when stock markets tank, it is essential to be careful when making these investments. One way to benefit from the lower cost of equities is to change the allocation in long-term investments such as National Pension Systems, NPS, and unit-linked insurance plans, ULIPs. Both NPS and ULIPs are long-term investments with multi-year lock-in period. A stock market crash provides us perfect opportunity to increase our equity allocation at a reasonable cost and allows us to switch to a more aggressive asset allocation from a comparatively conservative allocation. If we do not know how to value stocks or don't have the time to research investment options, it might be a better idea to invest in professionally managed diversified equity mutual funds as compared to investing in individual stocks. Seventh, we must focus on making long-term investments. When stock markets tank, a few questions come up every time. Question 1. Will the stock market go down to zero? Question 2. Will the economy recover? Question 3. Can stock prices increase from here? Every time the answers are the same. The stock market does not go down to zero. The economy always recovers and stock prices go up, reaching new all-time highs. While short-term volatility is inevitable when we are investing in equities, how this volatility affects us depends solely on us. If we are investing for a long term, these ups and downs in the stock market should not bother us. So to conclude, Nifty or Sensex crash predictions cannot be done in isolation because the Indian markets are deeply integrated with global financial system. Since Indian equities are heavily influenced by foreign institutional investors, FIIs, a significant crash on Wall Street could also trigger a correction in Dalal Street. That's all for today. Thank you for watching the video.